And capital is very cowardly. If it senses that it is threatened, it does leave, and that proves the point.
Why is capital fleeing South Africa? Well, joining me to discuss is Magnus Heystek of Brenthurst Wealth. Magnus Heystek, welcome to the show.
Good afternoon, David. Thank you very much. Nice to be back.
Yeah, good to have you back. Always interesting chatting to you. So you wrote a piece, which we'll link to in the description, where you talk about capital outflows from South Africa and the poor performance of the JSE relative to global markets. What is driving that?
Well, of course, those two things are interlinked. I mean, if you look back at the history of the JSE, it was very much driven by foreign capital since its inception, and during the boom times, the gold rushes, the diamond rushes. So very much, there was never enough capital in South Africa to finance these mines and the factories that came, etc. And, for the last 5 years, since Cyril Ramaphosa took over, there's been a steady outflow of capital, both the bond markets and the equity markets. And I analyzed some figures sent to me by one of our fund managers. And, it's almost R1 trillion that has quietly left the JSE, because there's very little reporting on this. It comes in drips and drabs, and every week there's an announcement, there's an outflow, an outflow, an outflow. But it is quite substantial. It is depriving the JSE of oxygen, as I call it. And the simple reason is that the global world has looked at South Africa. And of course, remember, we were downgraded 3 years ago, 4 years ago, 5 years ago. We're still paying the price for those downgrades. There's still many people who seem to believe that these downgrades don't mean anything, but they do. They do in the global context of global fund managers had to move their capital out of South Africa to fall in line with the downgrade. So the JSE is reflecting, and the investors on the JSE are paying the price of this underperformance over the last 5 to 10 years. And I've done some analysis, which I might publish very soon. And that is, most pension funds, retirement funding products have not beaten the inflation rate over 5, 7, and even 10 years after costs, after inflation, which is quite a statement to make, but that's not the point. You asked the question, why is capital fleeing the JSE? Well, we can just look at the headlines of Business Day today, where the chairman of Anglo Industries, one of our very, very large conglomerates who sells to the consumer, local company, makes, manufactures, and sells. The chairman of this company basically said, we don't see any point investing in South Africa at this point in time. We're just refurbishing and improving efficiencies, because the economy is not growing, and the people as a whole are getting poorer. They can't afford our products. And we see that in medical aid contributions. We see that in membership of things like provident funds. Asset management companies are not showing any real growth. So the economy is shrinking. It's a macroeconomic call. It's shrinking. The amount of money flowing around in the economy is reducing. And what is flowing around is being taken out by, state consumption is slowly but surely pushing out the private sector. And this is the price that we're paying for that. We're simply crowding out the private sector. And capital is very cowardly. If it senses that it is threatened, it does leave, and that proves the point.
As the old saying, capital goes where capital is treated best. So that R1 trillion that you mentioned, over what time period has that exodus occurred?
Well, the numbers are essentially from January 2018. So it's effectively almost 5 years. The first month there was a bit of an inflow. January 2018 there was still a bit of an inflow, and the month before, during the height of the Ramaphosa. And since then it's just been a dreadful, steady and slow outflow of capital from South Africa. And we can see it in the prices of our stock markets, our main companies. There are many blue chip companies on the JSE, that have not shown any growth over 10 years. Any growth over 10 years. You can buy them at the same price you could 10 years ago. So, I mean, that's a sad reflection. The growth that we have had has mainly been the mining commodities space, the iron ore mines, the coal mines, the copper mines, etc. And those prices are determined elsewhere. And we also know that we could have sold much more of these products if our railway lines were functioning efficiently and our ports were functioning efficiently. So the little bit of growth that has come on the JSE has been determined by outside factors over which we have no control. It is a sad state of affairs. It's not nice to comment on it, but nobody seems to be talking about this. And it is impacting on investment decisions. People are saying, I don't see growth in South Africa. I need to build some kind of capital somewhere else or in another asset class or whatever the case might be.
Yeah, and that 1 January 2018 is relevant because that was the beginning of the Ramaphosa era. And what do you think explains some of the commentary from asset managers, market commentators trying to kind of talk up the Ramaphosa period when the underlying fundamentals have actually been going backwards?
Well, they're basically doing marketing for their products. They're trying to talk it up. They're trying to sketch a scenario which I don't believe is prevalent or exists. You know, it's pointless saying that shares on the JSE are cheap if you look at the historical metrics, you know, price earnings and all those kind of valuations that fund managers use to determine the valuation of a company or a country. But you cannot take it out of the context. The macroeconomic environment is extremely poor currently versus 10 or 20 years ago. So I don't buy the argument that the JSE is so cheap. We had a flurry of fund managers earlier this year in January, from January to about April, when our market was still fairly buoyant, coming out and saying, you know, local is the place to be and so much value in the JSE. Well, lo and behold, our market is down 22%. I mean, simply because they were hyping the market, trying to influence decision makers. And, you know, nobody kind of goes back and questions them. You know, were they not overly optimistic about South Africa? And we still find it. It's part of the game. You see it in the... So when asset managers criticize me on a personal level, I understand where it comes from. They're basically seeing their businesses showing severe signs of stagnation. But I don't work for the fund managers. I work for my clients who ask me to analyze various investment opportunities and make an honest call based on my facts. And it doesn't mean I'm always right, I'm often wrong, but I simply still, at this point in time, considering the macroeconomic environment, the collapse of infrastructure almost on all levels, roads, water, sewage, I see petrol is now at risk. You cannot convince me that the JSE or companies listed on the JSE can make meaningful profit growth in such an environment, because it's an extra tax on a company on so many levels. So, you know, as a company, we at Brenthurst, we still remain very, very reluctant to commit large amounts of money to the local market. We find great value in the bond market, but that comes at a price for the rest of the country. We are forced to pay high interest rates on our bonds because that's the only way that we can attract some kind of capital into our markets.
Yeah, and to your points about the operating environments in South Africa, I mean, Warren Buffett, for example, is quite famous for saying, well, you shouldn't think in terms of shares or equities, you should rather think in terms of companies. And if you're a dairy farmer or a bread baker operating in this environment, a mining company, you know, you're faced with the same daily challenges that the rest of us are facing.
Everybody in retail or wholesale or transport or mining or construction, I mean, we have cases where, let's take construction as an example. We have the mafia, the construction mafia arriving at sites demanding to take 30% of the contract value on some flimsy pretext. And Calgro, a very large player, they've pulled out of KwaZulu-Natal. So it's just not feasible anymore for them to operate in KwaZulu-Natal. We have Bell, the equipment manufacturer, also citing that as a reason for closing their operation or scaling it down and moving out of the country. And that is done on a much larger scale, but not on the front pages of the media. But quietly, companies are just either shutting down or downscaling or moving away. We've seen Clover move its factory from Lichtenburg down to KwaZulu-Natal. So the macroeconomic environment is extremely toxic for business people, to such an extent that their lives are at risk, personal lives are at risk. We've seen many examples, and you can't talk it away. You just simply can't talk it away. And I'm not. It's not nice to talk about these things. I'm just calling it as I see it, and that leads through to where and how you should invest your money.
Magnus Heystek, thank you very much. Let's hand over to you, our audience. Where do you sit on the onshore versus offshore investment debate? Leave your thoughts down in the comment section. Don't forget to like this video and subscribe to the channel if you haven't done so already. Also check out this video over here for more content from the CRA. My name is David Ansara. Until next time, take care.